Now, there are two types of capital. One is called fixed capital and other one is called working capital, right? So fixed capital mean when you purchase land, building, right? Fixed capital mean land, building, machinery, and working capital mean current assets. Sorry. So working capital is a process in which we buy, yeah, we buy raw material, absolutely right, from supplier, or rather I should write buy from supplier. Then you process inventory, convert raw material into finished goods. Then you sell it to your customers. Right? And then you receive from customer and then buy again from your supplier. So this cycle is known as cash cycle. This cycle is known as cash cycle. Yes, sir. So sometimes happens, when the companies, they have land, building, machinery, everything, right? But they do not capable of managing their working capital cycle. Okay. So even they become problematic for them, problems for them. Like you have land, building, machinery, everything, but you do not buy from your suppliers properly, or maybe, okay, let me give you an example. Let's suppose you buy from suppliers and you deal with them with 30 days. That after 30 days, you will pay to your suppliers. Okay. And it takes you from 15 days to convert your raw material into finished goods. And then you sell to the customer. It takes you 10 days to receive your money from your customers. Okay. Now it means that converting your raw material from, converting your inventory from raw material to finished goods and then sell to the customer, it is 25 days. And after 25 days, you're receiving money and paying to your suppliers in the 30 days range. Okay. So this is a good working cycle. This is a good cash cycle. Yeah. So this is effective. I mean, with this, you do not face any liquidity problem. But what would happen if, again, 30 days with the suppliers, and it takes you 25 days to convert your raw material into finished goods, and further, it takes more 20 days to receive money from your customers. Then it is taking how many days? 45 days. And you have to pay how many days? 30 days. So it will create a liquidity problem. Now, this is what we call working capital cycle, working capital management. So this is a problem. And this is good. I'll share it to you. Yes. So now let's begin with this. The objective is to minimize the cost of maintaining liquidity with convertibility to cash to pay current obligations, right? While guarding against the risk of insolvency, inability to pay obligation as they come due. Now, the purpose of working capital cycle is to manage the things. I mean, you have to, whatever I have told you, right? This one. This is the payment section. You have to need to pay to your suppliers, and this is your receiving section. So the more quickly you are converting your raw material into finished goods and then receiving from the money from the customers, it will gives you more liquidity, strong position, right? So working capital policy applies to short-term decisions, and the capital structure finance applies to the long-term decision. Yeah, so capital structure is a long-term decision, whereas working capital management is the short-term decision. Now, this is called working capital management is called short-term liquidity management. We call it short-term liquidity management. This is called working capital, right, sir? But when we have to manage the long-term liquidity, that is called capital structure. This is your short-term liquidity management. And long-term liquidity management means issuing share capital, managing your debts. That is your long-term capital. Is this clear? Okay. Now come to the point. Now, net working capital formula is current assets minus current liability. When you subtract all the current liabilities from current liability, you will left with net capital. So the more you have net working capital, that shows that you are liquidity wise secure. But there is a problem that sometimes you have more current assets as compared to your current liabilities. But again, you have to look into that. If the inventories are more and you are not getting it converted into finished goods, then again it is a problem. Okay. Yeah. Okay, let me tell you one thing. Let's suppose you will understand with this example. Let's suppose we have current assets. Inventories, right? Trade receivables, bank, cash, and again we have current liabilities. Right, sir? So let's suppose we have inventory 100,000, receivables 20,000, bank we have let's say 4,000, and cash we have let's say 5,000, and current liabilities we have let's say 60,000. So your net working capital will be net working capital is the difference between total current assets minus current liabilities. So let's suppose the sum is, this is your sum. So this will be this minus this. Okay, now do you think that this is a good net working capital? Yes, it is good because your current assets are higher. I mean, you can easily meet your current liabilities. But the point is, you need to compare it with your inventory days. If your inventory days are also low, okay, always compare net working capital with your inventory days. Always remember. Let's suppose your inventory days, I'm just giving you an example, 25 days. So that shows that you can easily convert your inventory into finished goods. It takes you 25 days to convert your inventory days. Raw material to finished goods. Yeah. So it takes you 25 days to convert your raw material into inventory, finished goods, right? But if it is more, then it's a problem. So let's suppose your inventory days is maybe 90 days. Now in this situation, the holding so much inventory will not be a positive sign. Rather, it will be a negative sign. Because the difference, 69,000 is coming or I make it like this. Let's suppose 29,000, right? 29,000. 100,000. So this difference is coming because of inventory. And your inventory cycle is very low. It means that you are not managing your inventory efficiently. Is this clear? Yeah. So you have to look into the detail. I mean, it will not always be a case that or whenever net working capital is high, we are in a good situation. No, it is not always the case. So we have to check that if the net working capital is high, then why it is high? Are we struggling with inventory days? Or we need to invest money into why we are not increasing our profitability as well? Because working capital management is to create a balance between liquidity and profitability. If you remember, I've already told you. Working capital management, WCM, working capital management is to achieve a balance between profitability and liquidity. Profitability and liquidity. You have to create a balance between them. If you are not creating a balance, then there will be a problem. I mean, in this case, the case I have told you, you have high level of liquidity, but low level of profitability. Why? Because you are holding unnecessary this inventory. Because if your when your profitability is low and liquidity is high, that means that you are not your profitability is low. And when your profitability is high and liquidity is low, it means you are going to bankrupt. Here you will lose your market share, right? And here you will lose your liquidity strength. You have some question, please do it.
Yeah, now one. Another scenario, sir. So raw material, we can convert it to finished goods. It's a short period of time. But we ultimately, if we can't sell the product, we can keep it in the warehouse for long period as a finished good. That also leads to this issue, right?
Ask again, please. Sorry.
Now, one scenario is raw material inventory. Usually raw material we will keep it to convert. So the way we have working at the machine. Another scenario, so we can convert with the short period of time from raw material inventory. From making it to finished good, we can't sell it.
Yeah, same problem. Same problem. You are absolutely right. I mean, okay, the another case is, wow, what a great example you have given. Now, another case is, let's suppose the same situation is here. And now you have told me that you are good in inventory. So let's suppose your inventory is 20,000, but your trade receivables are 100,000. So again, your net working capital is high. But here you are specifically talking about receivable days. Receivable days. And it is, let's suppose, 90 days. So you are receiving money from your customers after 90 days. This is what you are discussing now. Yeah, so in this case, we have, okay, our net working capital is high, no doubt. But we need to take care of our trade receivables. So this is what I'm trying to make you understand. And mashallah, you are also understanding is also that net working capital is always high, should not be considered as your strength. I mean, you have to find out the actual reason that why is it so. So let me share it. Okay, now you can read further. What does it say? What is permanent working capital? Yeah, just read it out loudly.
Policy.
No, below the formula, working capital formula.
Permanent working capital is the minimum level of current assets maintained by a firm. Permanent working capital should increase as the firm grows. Permanent working capital generally is financed with long-term debt. Financing short-term debt is the because asset may not be liquidated in time to pay. The debt, interest rates may rise and loan may not be renewed. Monetary working capital fluctuates reasonably.
Right? Now you have working capital policy. A firm that adopts a conservative working capital seeks to minimize liquidity risk by, you see, now this is conservative approach. I mean, you are just taking care of your liquidity and you always increasing your current assets to be a safer side. Okay. So just to increase your current assets more as compared to your current liabilities. Number one, the firm seeks to ensure that adequate cash, inventory, and supplies are available and payables are minimized. Now you need to ensure that, yeah, this is absolutely true. You have adequate cash, inventory, and supplies are available to pay, and payables are minimized. Your payables should be lower, right? But at the same time, I think what should be the ideal, by the way, brother, what should be the ideal situation? I mean, just have a look here now at their Excel. What should be the ideal situation? Because in this situation, you are compiling your inventories. Here you are compiling your trade receivables. So we can have another situation in which let's suppose we have inventories 20,000, receivables 20,000, but we have 100,000 in our bank. Cash is also 5,000, and let's suppose the receivables 4,000. Now, do you think it's again a good situation? Why? Yeah, you should have utilized it now. You should invest somewhere. So again, I mean, the problem is to create a very good balance. To create a good balance between, yeah, current assets and current liability. So the firm foregoes the potential higher returns from investing. Yeah, this is the point. Now you are not investing somewhere, that is why you are foregoing the returns. This policy is reflected in a higher current ratio, current assets divided by current liabilities, and asset test ratio, quick asset divided by current liabilities. Now liquidity ratios are presented in study one. And okay, yeah, we have already gone through those liquidity ratios. Now firm that aggressively a firm that adopts an aggressive working capital policy seeks to increase profitability while accepting reduced liquidity and a higher risk of short-term cash flow problems. Right? So this policy is reflected in a lower current ratio and asset test ratio, right? So do you remember the formula of the ratios? Current ratio and quick ratio. Like in this case, right there. Yeah. Like in this case, we have current ratio, right? And current ratio is current assets divided by current liabilities. So let's suppose we have current assets and current liabilities. So the current assets are right side, and the current liabilities are this. So your current ratio will be current assets divided by current liabilities. Yeah, too much. I think for every time this will be same because I have only shuffles the things, right? And what about quick ratio? Now the formula for quick ratio is a bit different. And you better know that in quick ratio, we have to subtract our inventories from the current assets. Yeah, so we need to calculate quick assets. And the formula of quick asset is equal to this minus this. You see, now your quick ratio will be quick ratio is equal to this divided by this. Now you can see that here there is a huge difference between in case B, in column B, there is a huge difference between current ratio and quick ratio. When there is a huge difference between quick ratio and current ratio, and at the same time you have very high inventory levels, it means this is not a good liquidity condition. Rather, you are not managing your working capital efficiently. It's a poor situation. In the second situation, there is a less difference between current ratio and quick ratio. But again, the point is why you are keeping your quick ratio so much high? Because the standard quick ratio should be 1:1. I mean, just keep it 1:1 and put the rest of the money in somewhere, invest somewhere, right? So instead of, I mean, because here, quick assets are 109. So if we want to keep it 1:1, so it should be 29,000. The rest of the, I mean, let me check this minus this. So this amount should have been invested somewhere. Investment required. Because if you do not invest this amount somewhere, then there is a problem. Then you are not maintaining a good balance between liquidity and profitability. Am I right, sir? Carrying excessive current assets such as inventories, everything. Now let's move further. Okay, now you need to also remember, brother, that these are the ratios which you simultaneously need to analyze for your liquidity. The worst thing is current ratio. Okay, then quick ratio, then payable periods, payable period, inventories period, and receivable period. Receivable days, in fact, I should say. Receivable days, payable days, because it will be days now. How many days you take to pay your suppliers, how many days it takes you to convert your raw material into finished goods. So these five ratios are extremely important to analyze your business situation. Right, sir? Anything else you want to share or ask, just let me know. Because we are discussing a very interesting topic. By the way, this is one of my favorite area, working capital management. Yeah, practical, challenging, balancing, everything. We will end by June and inshallah, everything. Yeah, then we'll restart. CMA part 2. right side. Now, managing a level of cash, this is very important. The following are the three motives for holding cash. Number one, transactional, precautionary, and speculative. This is for sure. Transactional mean as a medium of exchange, precautionary mean to create a reserve for contingency, and speculative mean to take advantage of unexpected opportunities. Now, the firm's optimal level of cash should be determined by cost benefit analysis because cash does not earn a return. Cash does not earn a return. If you hold cash, it will give you a nothing. So only the amount needed to satisfy current obligations as they come due should be kept. So you should keep that much cash that is available to pay the liabilities. That is for sure. Now, the motives for holding cash must be balanced against the opportunity cost of missed investments in marketable securities. The expected return on available investment projects must exceed the return on investments of comparable risk. One approach is the economic order quantity model originally developed for inventory management, right? Now we have EOQ model applied to cash management. Now, this is the formula. Q is the optimal cash balance. P is the fixed cost per transaction. T is the total demand for cash for the period, and I is the interest rate on the market securities. So that gives you how much cash you should keep in your business. Now we have this question. Now, firm projects that it needs $20,000 to pay its obligation during the upcoming month. Every marketable security transaction costs $5 and securities are currently paying 6% annual interest. The optimal cash balance would be, so just put the calculations in, and that would be 6,324. The firm's optimal cash balance for upcoming month is this. I mean, this is what you need to keep in your business, and rest of the thing you should invest in the very right. Now we have forecasting future cash flows. Managing cash flows begins with the cash budget. It states projected receipts and payments for the purpose of matching inflows and outflows, right? Now the budget is for a specific period, but cash budgeting is on ongoing cumulative activity. It is re-evaluated constantly to ensure all objectives are met. Cash collections forecast. A firm forecasts the following cash collections for the next 4 months. You have cash sales and credit sales. So you will make the budget, right? On average, 50% of the credit sales are paid for in the month of sale. 50% of credit sales are paid for in the month of sale. I mean, the month in which you make sale, you get 50% amount, and 30% in the month after sale. Now the firm forecasts the following cash payments for the next 4 months. Let's suppose July, August, September, October. Now we have different purchases and we have total sales, right? Now in July, we have total purchases 200,000 and total sales 200,000. In August, we have purchases 250,000, total sales 280,000. In September, we have 300,000 purchases, total sales 420,000, right? So on average, the firm pays for 50% of purchases in the month of purchase and 25 in the year of in each of the following 2 months. Now, payroll is projected as 10% of that month's sales and operating expenses are 20% of the following month's sales. So, November sales are projected to be $280,000. Interest of $5,000 is paid every month. So, the firm projected cash payments for October can be calculated as follows. Now, these are the cash payments, right? Now, in the month of October, you purchased 350,000, but you paid 50%, right? So $175,000 you already paid. And regarding the September's purchase, 300,000, you still paying 25%. Because that is how you pay now. 50% in the following months and 25% in the second month. Sorry, following 2 months. So for August, again you are paying 25%. And you are also paying October payroll also and October interest expense. So that is how you create a cash limit. I mean, this is very easy, though it needs some concentration, but the things are very simple. I mean, that is how you can forecast your cash flows and everything. Now, speeding up cash collections. The period from when a payer mails a check until the funds are available in the base bank is float. The firm use various strategies to decrease the float time for receipts. The product of the daily amount of receipts and the number of days of reduced float is the increase in the average cash balance. This amount is multiplied by an annual rate of return on the short-term investment, which is the opportunity cost of the funds to arrive at the annual base. Yeah, I mean, this is not that much. Okay, now you come to page number 183, which is called marketable securities management. How do you manage the marketable securities? Idle cash incurs an opportunity cost, right? Now you have that idle cash with you and you are not investing somewhere else. So it is costing you, which is called opportunity cost, because you could have invested in somewhere else to get some return. The return that could be earned if the cash was invested, the return that could be earned if the cash was, if you invest that cash somewhere, you could have earned better return. To offset this cost, firms invest their ideal cash balance in marketable securities. Now, what companies do, they take the ideal cash and invest in the marketable securities. Marketable securities are short-term securities for 3 months, 90 days. So you invest some security after 90 days, you get the return. So instead of keeping cash in your bank, why don't you invest in marketable securities to increase your profitability? And again, marketable securities are very much, uh, they are very liquid. Liquid means whenever you want, you just sell it and get it converted into cash. Now, entity also must consider whether the maturities of marketable securities match the needs for the cash. Beyond achieving an optimal risk and after tax return trade-off, the most important aspect of marketable securities management are liquidity and save. So liquidity is the ability to convert an investment into cash quickly without any loss of. This is very important. I mean, you have to select an investment project in which you invest and quickly convert into cash without a loss of principal. Principal mean the original amount you invest. I mean, if you invest, let's say 10,000 Qatari riyal for 3 months, at least you should earn more than 10,000. If you're also losing some part of that 10,000, that would be not a good liquidity strategy. Now, marketable securities management thus concerns low yield, low risk instrument that are traded in a highly active market. So basically, marketable securities, they are not that much that give you so much high return, that give you a very low return because of 3 month security. So types of marketable securities are, they have provided you the types. The money market is the market for short-term investment where firms invest their temporary surplus of cash. The money market is not formally organized. It consists of many financial institution, firms, and government agencies offering instruments of various risk levels and short to medium range maturities. US Treasury obligations are the safest investment exempt from state and local taxation. Number three, high liquidity, right? So now we have treasury bills. Now T-bills have maturities of 1 year or less. They have no coupon rate and are sold at a discount rate. Now T-bills, United States of America, they issue these T-bills. they buy on discount and they mature it on the principal amount. I mean, let's suppose if we are in United States of America, and the one T-bill is consists of, let's say, $100. So they can issue at $95. So we can purchase at $95, and after 1 year maturity, they can buy back for $100. So there is a $5 benefit for us.
Plus interest.
No, it doesn't carry any interest. Yeah, it's a short term. Short-term securities doesn't carry any interest. Now just have a look at this example, 7-6. Try to understand this 3%. The cost is 970. So you buy it for 970 and they will take it back for 1,000. The investor receives $30 of interest when the bill matures. I mean, they are calling this interest, but this is basically a setup, right? So you buy it for 970 and they buy back from you for $1,000.
This is what the one I didn't see. That would be reasonable even for some very, the companies and the.
Yeah, I mean, cost is 980. You are purchasing it for 980, and after 6 months, they will pay you 1,000. So you will get $20 for 6 months at the investment of 980. I mean, you invest 980 in the T-bills, and after 6 months, you will get $1,000. So, I mean, do you think it's a good investment opportunity?
Return is very low.
Yeah, return is very low. I mean, $20 for 6 months, it's nothing. And even if you want to increase it, you have to buy, or if you are very wealthy and you can buy so many T-bills, you have extra money. And so let's suppose, if you want to earn $20,000, $20,000 divided by 20. So you have to buy 1,000 certificates. 1,000 certificates mean $1 million investment. Huh? So T notes have maturity of 1 to 10 years. They provide the lenders with an interest payment every 6 months, and T bonds have maturity of 10 years or longer. So we have treasury bills, treasury notes, and treasury bonds. Treasury bills are short term. Treasury notes and treasury bonds are long term. Now, federal agency securities are backed by either. Okay, no, this is not that. Then you come to page number 185, receivable management. Now, this is very interesting, receivable management. Receivable management is also referred to as trade credit policy, right? So account receivables are carried for competitive and investment purposes. A firm almost always must offer credit if its competitors do. Customers who choose to pay beyond the stated time limit can be charged financing fees. And due to the interaction of these two factors, managing accounts receivables must involve the sales, finance, and accounting functions. Now, administrative factors influencing the level of receivables include the soundness of the procedures for evaluating customer creditworthiness, formula for establishing standard credit terms, system for tracking accounts receivables and billing customers, and procedures for following up on overdue accounts. Now we have market factors influencing the level of receivables include the cost of borrowing and the opportunity for repeat sales. Low gross margin per unit and operating at full capacity are reasons not to ease credit terms. The optimal credit policies does not seek merely to maximize sales. This result could be accomplished by increasing discounts, offering longer payment periods, or accepting riskier customers. But the firm cannot ignore the increase in bad debts and its negative effect on cash inflows. Thus, the firm must balance default risk, bad debt experience, and sales maximization. Then we have default risk. Default is the probability that a particular customer will be unwilling or unable to pay a debt, right? This is default risk. To manage default risk, firm often require written agreement to be signed by the customers, outlining the terms of credit and the consequences of for non-payment. Firms often use credit scoring to determine whether to extend credit to a specific customer. Credit scoring assigns numerical values to the elements of credit worthiness. Now they assign some credit scoring. I mean, if there is a customer whose credit score is very high, you can rely on him, right? If there is a customer whose credit score is low, you cannot rely on him. And then cash conversion cycle, we have already gone through this cash conversion cycle, right? Now, this is very important. Aging account receivable. This is one of the beautiful technique which is being used by the companies. So we have a balance range, right? If you have less than 30 days, 31 days, 61 to 90 days. I mean, that is how you will create a schedule. If there is a customer who is over 90 days, you will always expect uh, less amount to receive from him. Huh? Right, sir? No, it says that Midberg then applies an appropriate percentage to each stratum based on the experience. Now, his experience is that if it is less than 30 days, 2% is uncollectible. But it is if it is over 90 days, 20% is not collectible, right? So they have balance. 71,000 is the amount which is less than 30 days. And they are expecting that 2% will be bad debts. So it will be 1420, right? And then 30 to 60 days. And over 90 days, we have 1,000. So they are expecting 20% to be. Yeah. Is this clear, sir? Very simple. I mean, now basic receivable terms. The most common term credit terms offered are 2 by 10 net 30, right? Yeah, 2 by 10 net 30 means the average time they have is 30 days. So if they pay within 10 days, you will give them 2% discount. Right?
Minimum 2-10
2-10 mean, I mean, the total credit period is 30 days. But if your customer pays within 10 days, you will give him 2% discount. This is called the term 2 by 10 net 30. Now, this conversion means that the customer may either deduct 2% of the invoice amount if the payment is paid within 10 days. Now, if they pay within 10 days, they will avail 2% discount. Or if they do not avail the discount, they have to pay the total amount on 30th day, right? Now, the credit terms do not include quantity discounts. Which affect the prices of purchases, not financing. Credit terms do not include quantity discount, right? Which affects the prices of purchases, not financing. Now, the average collection period, yeah, we have already discussed it. Average account receivable days, we have already discussed it. Now, this is what we assessing the impact of change in credit terms. Yeah, this is important. Let's suppose a firm is evaluating a proposal to relax its credit standards, right? Under the new plan, credit sales are expected to increase by $600,000. The new customer attracted by this plan are expected to have a 40-day average collection period. Now, there are 360 days in the year, variable costs are 80% of the sales. So increase in sales is $600,000, variable cost ratio is 80%. So increase in variable cost is $480,000. Now increase investment in receivable will be 480,000 multiplied by 40 days divided by 360 days, which is 5,333. This will be increase in receivable investment. I mean, this is the amount which will be locked under the receivables, right? Then the cost of change in term is also calculated. Increase investment in receivable multiplied by opportunity cost fund. I mean, now you see, this investment in receivable is 53,333 and the opportunity cost of the fund is 12%. So the cost of this is 6,000. I mean, if you do not let this money be held by the receivables, you could have invested in some bank or some investing projects and you can easily earn 12%. It's the opportunity cost of that investment. Now you are not earning 12% out of this money rather than just holding it with your receivables. Yeah, that is why you have to do a good comparison before taking any decision. Now, the benefit or loss resulting from a change credits calculated this formula, incremental contribution margin and cost of the change. Now, the increase in sales 600,000 and contribution margin ratio is 20% because the variable portion is 80%, right, sir? So, increase in contribution margin is 120,000 minus the cost. So, the benefit of the new plan is 113,600. This is the benefit of the new plan. That is how you can calculate it. Then factoring, this is again very interesting concept. Factoring means when you sell your receivable to your bank, right? So factoring is a transfer of receivable to a third party who assumes the responsibility of collection. A factor usually receives a high financing fee plus a fee for collection. Furthermore, the factor often operates more efficiently than its clients pay because of the specialized nature of its services. Now, what factoring receivables are? A factor charges a 2% fee plus an interest of 18% on all cash advance to a transferor of accounts receivable. Monthly sales are $100,000 and the factor advances 90% of the receivables submitted after deducting 2% fee and interest. Now, credit terms are net 60 days, which is the cost to the transferor of this arrangement. Now, the amount of the receivable submitted is 100,000, right? Is this clear? Now you are selling your receivables worth $100,000. Now the bank will hold this 10% as a reserve with them. Okay. And they will also charge 2% fee, which is 2,000. So the amount agreeing to the transfer is 88,000. And also they further deduct the interest because bank charge interest. So they will give you 85,360 immediately, right? Yeah. So if you sell your $100,000 receivable to bank, they will immediately give you 85,360. They are charging you interest for 60 days because after 60 days they will be receiving money. And 2% is the factor fee, their service charges, and 10% is what they hold. So Joseph Ibrahim is also not there. Dolly was there. She never comes. Value is there. Amna is not there. Sirishan always there, right? Zia is not there. Surya is not there. Shirishan is there, and Amreen is there. Okay. Yeah. I always mark it. You're always present, Michelle. So the next thing is inventory management. Now, inventory is primarily held for sale to the customers. This is for sure. We hold it to sell it to the customers. Now, additional reasons for carrying inventory include protecting against supply uncertainty. You see, vendors may have financial difficulties or shipments may be delayed. So you need to hold your inventory for your customer because sometimes if you do not hold your inventory, then it might possible that maybe your vendor could not be able to supply you in time, or there may be some delay in the shipment. So if there is a delay in shipment, you will lose your customer. Now, protecting against fluctuations in demand is also very important. Sometimes demand goes high to because of seasonal factor or maybe Ramadan. These considerations are balances to ensure that operations are not interrupted by inventory. So, as an inventory manager, you should be very vigilant. You should have very good control on your inventory. You have projections, everything you have considered in your inventory management. So you do lot of analysis, lot of time series analysis. So you might have trends like maybe in the month of Ramadan, the things are sold more. So you may have more stocks before the Ramadan gets started. That is how you need to understand it. Now, cost related to inventory, minimizing total. Now, this is the important point. The purpose is to minimize the total inventory cost. Okay. Minimize total inventory cost because there are three costs are there, you see, or even four. Purchase cost, carrying cost, ordering cost, stock out cost. Now, purchase cost means when you purchase from your suppliers. Carrying cost means when you have to carry it in your storage, like you see, holding inventory, storage, insurance, security, depreciation, everything, obsolescence, spoilage, everything. And ordering cost means that when you have to order it, then obviously there is a shipment cost. And then stock out are the opportunity cost of the missing a customer order. I mean, there is a customer, but you do not have the inventory in your stock. So there is opportunity cost of losing that customer. Now, per unit purchase cost and carrying cost. The following costs that are available for an item of inventory. We have invoice price. Let's say $300 per unit. Shipping cost $15 per unit. Inventory insurance $5 per unit. Handling cost $80 per order. Order cost $15 per order. And cost of capital is 20%. The per unit purchase cost and the cost of carrying a unit of inventory can be calculated as follows. Now you have invoice price and you have shipping cost. So per unit cost will be 13,315. Now the cost of capital is 20%. So the opportunity cost is $63 and insurance inventory is 5. So per unit carrying cost is $60, right? Now we have an example. So brother, you just understand. A wholesaler has offered a home and a garden company a year-end special purchase whereby it could purchase 30,000 bags of mulch at $3 a bag. What is mulch basically? MULCH. What is this? Mulch is a layer of material applied to surface of soil. Okay. Okay. The company normally orders 5,000 bags of mulch per month at 4.5 a bag. I mean, this is what company normally do, right? They order 5,000 bags at a cost of 4.50. Now, the company's cost of capital is 8%. In calculating the overall opportunity cost of this offer, the cost of carrying an increased inventory would be 1,350. If the company makes the special purchase of 6 months of inventory, 30,000 bags divided by 5,000 bags per month, the average inventory for the 6-month period will be $45,000. 30,000 multiplied by 3 divided by 2. If the special purchase is not made, the average inventory for the same period will be average monthly inventory of 11,250, which is 5,000 multiplied by 4.5 divided by 2. So accordingly, the incremental average inventory is 33,750, which is 45,000 minus 11. Okay. And the interest cost of the incremental 6 months is 1,350, which is 8% divided by 2. Now that is how you calculate all the things, right? Okay, now we have another thing which is called yes. Now this is called economic order quantity, EOQ. I mean, you can see this graph. Carrying cost is continuously increasing, right?
Yes.
Purchase cost remains constant, but the carrying cost is increasing. Why? Because if you keep on purchasing the units, you have to pay a lot more for your storeroom to carry that inventory. Now, economic order quantity is a cost, is a graph that gives you lowest total cost. Now, economic order quantity means it's a quantity. If you order that quantity, the carrying cost and the order cost will be minimum. So it's a particular point. If you increase your units or if you decrease your units, the cost will either case will increase, right? Because you can see if you order less quantity, just have a look, brother. If you order less quantity, if you go left side to the graph, the carrying cost is getting decreased, but your purchase cost is high. You see, and if you move to the right side of the graph, the purchase cost remains constant, but carrying cost is increasing at the same time. So you try to achieve a point where both of sum of both costs. Yeah. Now we have another technique which is called just-in-time technique. You just read it. This is very famous technique. Just-in-time means that you put all the burden of inventory on your supplier. So your supplier is responsible to make your all goods available at time, right? Then we have some inventory replenished with certainty. Now this is very interesting graph. There is a reorder level. I mean, when inventory reaches at that level, you order it again. So it keeps like this, right? So the formula of economic order quantity, if you just have a look at a page number 193, at the bottom of page 193, the formula is square root 2AD divided by K, right? So let's suppose the fixed A is the fixed cost per purchase order. And D is the periodic demand in units, and K is the carrying cost per unit. And 2 obviously is the constant. So that will provide you that how much unit you should purchase in order to decrease your total cost. Right, brother? So we have done this chapter, Alhamdulillah, and let us have a look at the index. You can see how many chapters you are remaining with. There is only 3 chapters: pricing, margin, and CDP. Rest of the things have been covered up. Right, sir? We have done this, na, valuation methods and cost of capital. Yeah. Expected rate of return and everything. So only 3 chapters are remaining. Chapter number 8, you can study by your own self. So by the end of June last, inshallah, we will cover it.